Hi everybody, welcome back to the channel. So if you've been following the stock market lately, everything's been going down and this is the worst start for the S&P 500 since 1939. Almost the worst start in about 100 years for the stock market, being down about 15% for the S&P 500. And our TFSA is down as well, so we've lost $986.92 or down 7% on the month in our tax-free savings account. We're still in the green just by a little bit, so we're still up all time, but it's been brutal. We've lost pretty much all of our gains, but our passive income continues to go up. And quite frankly, this is a bear market, and this is my favorite type of market, which is weird to say, but I'm going to go over that and discuss the benefits of having this type of market when you're a dividend investor. So with that said, please like the video, leave a comment, and now it's time to roll the intro. So here are the different types of markets and how they affect you as a passive income dividend investor. So in a bull market, pretend that you're pushing a snowball up a giant hill. So a bull market is one in which stock prices keep climbing, they go higher. But there's a downside to this. One, your snowball grows pretty slow and you have to put in a lot more work. So for you to get growth during a bull market, you need to invest a lot more money because your money buys a lot fewer shares and it pays a much lower yield. So this is actually the worst type of market, and you get the lowest overall return out of the three market cycles that you have. I mean, there's two major ones, but I'll talk about the three different ones that can happen. So the bull market is when the market's going up. So this is the worst time for a passive income investor. Fewer shares, lower dividend yield, the snowball grows slow, and the main thing growing your portfolio is your regular contributions and just dollar cost averaging in every week. And the flat market is going to be just a sideways market. This is a market that doesn't go up. It doesn't really go down. So the benefits of this market is you get a medium yield. Your snowball grows a little bit faster than in a bull market because your shares are, you buy basically a medium amount of shares. You build your snowball at a medium pace. And, there's still a bit of work, but it's not like rolling a snowball up a giant hill, which you can imagine is very, very difficult. And then we have the bear market. And this is why this is my favorite market to invest in. So here are the benefits. You get a much higher yield. Your snowball grows very, very fast. So your dividends just become large much, much faster. And it's a lot less work. Just imagine rolling a snowball up a hill versus rolling it down a hill. Very little effort is needed on your part, and it just expands and multiplies. And you will reach your goals a lot faster, and you will get a higher total return. So that's why I prefer the bear market, because I'm going for passive income. I'm not concerned with my portfolio value, which is volatile and is just going to be primarily determined by how the market feels at any one point. Right now, the market doesn't feel good, so my stocks are suddenly worth a lot less. But you know what? My passive income keeps growing, and that's the main thing I'm going to focus on. Start with the RRSP, which is our smaller account. It's about a month old, so we have $394.88, so we're down 12%. I only hold one stock here, so I just have Starbucks. They are facing some negative pressure from the unionization, but I mean, this stock has plummeted. It was in the 120s. Now it's in the 71 range. I started buying it in the mid 80s. I just bought one more share, so we went from like 3 to 4 shares, and we're down 15% on the position. But again, I'm not worried. I'm not worried about the company in the least. So if this continues to decline, I'll just continue to average into the position, and we're going to keep reinvesting the dividend that I get here. And the reason I placed it into the RRSP and not the TFSA is when you hold an American listed company that pays a dividend, if you have it in your TFSA or your personal account, there's a 15% withholding tax on your dividends. However, if you have it in your RRSP, you keep all your dividends. So This is a company that I'm primarily buying for the dividend. It obviously will grow as well in share price too, but primarily for the dividend. So that's why I stuck this here. And just the rate that they grow their dividend is a big reason why I wanted to buy this company, especially when it's out of favor, because it is a quality business out of favor, and I believe it is a good price right now. And with the portfolio, here are the changes I've made. So we can see that even big tech like Apple is going down a lot. So I'm going to watch this closely. We're still in the green on this position, but if it dips down and it goes into the red, I'm definitely going to be interested in adding more Apple, especially since Warren Buffett bought about a lot of shares actually, and Apple's almost half of his portfolio at Berkshire Hathaway, so he definitely feels that Apple's a good value at 150. And I'd say that that's probably a pretty fair statement to make, and a pretty solid company overall. And if this were to fall significantly, I'd be very comfortable. I wouldn't even blink. I would just see a giant green light and buy tons and tons of Apple. Just a great company. You could say it's the best company in the world. You can make that argument. I also purchased a share of Algonquin Power, so it went from the 19s down to 17, so I decided to buy one more of this, going up to 43. I am surprised that it's not as defensive as I thought it would be. Like if you compare this to a company like Fortis or Hydro, those companies have held up a lot better than renewable power. And I think that also has to do with the inverse relationship that renewable energy has with oil. So like when oil is really popular, the renewable segment typically goes down. So it's kind of an interesting inverse relationship that we have there. Alibaba's, down, but it's always down. So it came early to the market crash. It was first to the party. So no real change here. Not worried about the company. They do report their earnings pretty soon this week, so we'll see if that affects the numbers. Again, I think that this stock is going to be down for a while, but I think it does have the potential to go up. So that's why I haven't sold out of the company. I haven't lost faith in the company yet. I purchased 2 more shares of Brookfield Asset Management. So we went from 8 to 10 shares, just a great business, and it falling to the low 60s. I just wanted to get more of this fantastic company that's very diversified. So a lot of different fields and very good historical returns. And we can see that the banks have held up pretty well, and even the income funds have actually started taking a bit of a hit, and especially Ethereum. So I'm going to say like any kind of a risky asset, investors are not interested in risky assets right now. So these are very, very beaten up. And we can see Google is also down slightly, but again, Google, Apple, and I'd say even Microsoft are holding up a little bit better than the rest of the market, at least in big tech. I also purchased 4 more shares of HYLD right now. So this is a covered call ETF that has 7 different U.S. listed ETFs, and it's paying about a little over an 11% yield right now, which technically does beat the market, since the market expects to return about 10%, roughly 8 to 10%. So if this falls further, I'm definitely just going to keep averaging into this, keep picking up more shares of this, and keep increasing our passive income in the portfolio so we can keep purchasing more and more shares. And Loblaws actually had incredible earnings, and they raised their dividend by 11%. So this is a great one. I'm very happy with the performance of Loblaws, and they're holding up extremely well in this market. So I wish I bought a little bit more of it when it was at 100, but I mean, what can you do? It shot up before all this market turmoil. So I don't think it's quite the value that it once was. So I'm going to hold off on purchasing more for now. And Microsoft has dropped tremendously. I'm very interested in buying this. There's just one more thing I'm going to wait for. I'm waiting for Disney to release their earnings on Wednesday. I have a little bit of money. I'm just waiting to see if Disney has a good or a bad earnings report. If it has a bad earnings report, the stock might fall a lot, and I'd be interested in starting a position. So there's a couple stocks I'm interested in. So either I'll buy Disney maybe. If Disney goes up after good earnings, then I'll ignore it, and I'll probably either purchase either Microsoft or Lowe's. Those are 2 stocks that I think are very, very pretty attractive prices right now and have been beaten up recently. And I also picked up a little bit more smart centers. So we went from 20 to 22 shares. And this is the lowest price it's been in a while. So this one is giving about almost a 6.5% yield right now. And it pays every single month. So real estate has been taking a real hit. I'll probably just keep dollar cost averaging into real estate over the coming weeks and coming months, and just keep increasing our passive income. So I was really happy to get some smart centers, at like 28 a share. So that was really good. And TELUS actually reported excellent earnings as well. And they also did a dividend raise of 7%. So my income increased in the portfolio without me having to do anything. And that's just great. I mean, I haven't gotten any raises from work lately. I know a lot of people don't, but getting it for your passive income, doing absolutely nothing, just holding shares of quality companies and collecting that increasing stream of cash flow every single month is great. And we reinvested the dividend that I received from TD, so $13.72. So I increased this one as well. And Tesla has fallen a bit, but I'm not worried at all. So any kind of a growth stock where the profits are going to be more in the future and not so much in the present. I think the only reason Tesla's holding up so well is because I think the shareholders of this really believe in the company, and also because it's a profitable company. The market is really punishing unprofitable companies at the moment. And now I'm going to show a clip of Peter Lynch. So he's one of the greatest investors of all time, and he ran the Magellan Fund for many years at Fidelity Investments. And he averaged a 29% annualized rate of return, which is insane. So he absolutely crushed the stock market when he was running this mutual fund. And I'm going to show you this clip of him talking about corrections and how they can be positive, just like I mentioned previously.
Study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. If you understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it, 14 to 22 is terrific, 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
So as I stated earlier in the video, and as Peter Lynch just stated in that video, the market going down is going to happen. There's nothing you can do about it, so just stay invested, keep investing every single week, and take advantage of these market declines. Especially if you're a dividend or income-focused investor, this is the best time and the best market condition to be buying stocks and increasing your passive income and increasing that snowball. And speaking of which, I've hit a major milestone in my portfolio. I've received over $500 in dividends since starting the portfolio. Money for doing absolutely nothing. Money while we sleep. Money while we live our lives, do other things. Annually, we can see that we've increased our dividend income from $7.03 up to $7.18. So that's an extra $15 a year coming in every single day, every single month, and helping us buy more stocks and increasing our income even faster than the previous time. Monthly, we're earning $59.90, so that's up from $58.66, so up over almost $1.30 or so. Pretty good increase. Weekly, we're making about an extra 30 cents per week. Daily, we're making an extra 4 cents every single day. It takes us 1.67 months to earn $100 versus 1.7. So this number keeps shrinking and shrinking. And our hourly wage, if our portfolio were to work a 40-hour work week, went up 1 penny per hour from 34 cents to 35 cents. We're very close to my goal of hitting $2 per day. We're at $1.97. So I just have to keep making deposits, keep buying more dividend paying companies, and we're going to reach that goal very soon. And then I can start going for the next goal, which is to get $3 a day in dividend income and keep increasing our passive income. So if you enjoyed the video, please do leave a like on the video, subscribe to the channel, and leave a comment. What are the stocks that you are buying right now in this market decline? Or are you just holding cash? Let me know what you're doing, what your plans are, and how your portfolios are doing in this bear market. All right, have a great day, everybody.